Welcome to Section 5 of the ASC 710 training series. This section covers deferred compensation arrangements, where employees defer receiving current pay to a future date such as retirement, and the Rabbi Trust, which is a common but often misunderstood funding vehicle for these arrangements. By the end of this section, you will be able to define deferred compensation and explain when the employer's obligation arises. Describe how and when to accrue deferred compensation expense over the service period. Explain what a Rabbi Trust is and how assets held in it are treated. Determine the correct balance sheet presentation for both the asset and the liability, and record journal entries for all common deferred compensation scenarios including accrual, funding, and payout. A deferred compensation arrangement is one in which an employee voluntarily agrees to defer receiving part of their current compensation until a future date, most commonly retirement. The deferred amounts are typically held or tracked by the employer and paid out when the employee retires, terminates, or reaches a date specified in the plan agreement. The employer's obligation under a ASC 710 is recognized over the period during which the employee renders the services that give rise to the future benefit, consistent with the matching principle. The deferred compensation obligation must be accrued over the service period, not recorded all at once when the payment is eventually made. This is a direct application of the matching principle. Each accounting period, the employer records a debit to deferred compensation expense and a credit to deferred compensation liability for the portion of the total benefit earned during that period. The accrual continues until the employee has fully earned the benefit through service, at which point the full liability is on the balance sheet awaiting payout. A Rabbi Trust is a type of trust established by an employer to hold assets set aside to fund deferred compensation obligations. The trust provides employees with some degree of security because assets are held separately rather than commingled with the employer's general operating funds. However, the key legal feature of a Rabbi Trust is that the assets remain subject to the claims of the employer's general creditors in the event of insolvency. The name comes from the first IRS private letter ruling approving such an arrangement, which happened to involve a rabbi's deferred pension. Because Rabbi Trust assets remain subject to creditor claims, they are not considered held for the employee's exclusive benefit. As a result, the assets stay on the employer's balance sheet rather than being removed. The deferred compensation liability also remains on the balance sheet. Critically, the two cannot be offset against each other. Gross presentation is required. The asset and the liability are shown separately, even though they represent two sides of the same arrangement. Presenting only the net difference is not permitted under a ASC 710. When the employer transfers cash into the Rabbi Trust to fund the deferred compensation obligation, the journal entry is a debit to Rabbi Trust assets or investments and a credit to cash. The asset is not removed from the balance sheet because the employer retains the creditor exposure. If the trust assets are invested in securities, they should be remeasured to fair value at each balance sheet date, with the change in fair value recognized in the income statement. The fair value of trust assets is therefore separate from and may differ from the deferred compensation liability. Each period as the employee renders service and earns more of the deferred benefit, the employer records a debit to deferred compensation expense and a credit to deferred compensation liability. The amount of the entry is driven by the terms of the plan and how much of the total promised benefit is attributed to the current period's service. The deferred compensation liability grows over the service period and represents the employer's total outstanding obligation to the employee at each balance sheet date. When the employee retires or reaches the date specified in the plan and the deferred amounts are paid out, the journal entry is a debit to deferred compensation liability and a credit to cash. Because the liability was fully accrued over the service period, no additional expense is recognized at the time of payout. The payment simply extinguishes the obligation that was built up over the years of service. If the trust assets are liquidated to fund the payout, a separate entry records the reduction of the trust asset balance. Bringing together the balance sheet presentation. The Rabbi trust assets appear on the balance sheet as an investment asset, typically classified as non-current if the obligation is long-term. The deferred compensation liability also appears as a liability, usually non-current. The two are presented gross, meaning no offset is permitted even though they relate to the same plan. The notes must disclose the existence of the Rabbi trust, a description of the assets held, and the fact that those assets are subject to the claims of the employer's general creditors. The most common error in deferred compensation accounting is presenting the Rabbi trust assets and the deferred compensation liability on a net basis, showing only the difference between the two. This is not permitted under a ASC 710 because no legal right of offset exists. The assets remain exposed to creditor claims and cannot be treated as if they have been set aside exclusively for the employee. Auditors specifically look for net presentation and will require gross presentation to be restored if they find it. Let us review the key takeaways from this section. Deferred compensation is accrued over the period the employee renders service, not when the payment is eventually made. Rabbi trust assets remain on the employer's balance sheet because they are still exposed to general creditors. The deferred compensation liability also stays on the balance sheet. Gross presentation is required, and offsetting the asset against the liability is not permitted. The notes must disclose the existence of the Rabbi trust and the fact that assets are subject to creditor claims. Thank you for completing Section 5 on deferred compensation and Rabbi trusts.